Nearly half of homeowners in America are now considered equity rich. Mortgage rates are hovering near their 3-year lows. A major housing bill just moved forward in Congress, and yet we just got a jobs report that may have temporarily thrown cold water on some rate momentum. Let's break down what actually matters. Hey there, it's Asher with NEXA Lending, and this is your weekly housing and mortgage market update, focused on what impacts buyers, homeowners, and real estate professionals right now. Let's get into it. Homeowners are still sitting on some massive equity. As of the fourth quarter last year, 44.6% of homeowners with a mortgage are now equity rich. That means nearly half of homeowners owe less than 50% of what their home is worth. Yes, that number has slipped slightly from the peak of 49%, but historically speaking, this is incredibly strong. On the flip side, only 3% of mortgaged homes are seriously underwater. That is up slightly from 2.8%, but it's still extremely low compared to historical averages. This tells us something important. Despite rate volatility and economic noise, homeowners' balance sheets remain strong. It's not 2008, it's not even close. Now, we do have some early signs of a more active spring market. Now, here's where it gets a little interesting. We're starting to see signs of life heading into spring. New listings are up 1.1% year over year. It's the third straight weekly increase. Months of supply is now at 5.4 months, nearing balanced market territory. Buyers actually have leverage right now. Sellers outnumber buyers by a record 47%. That's a negotiation environment we haven't seen in many years. At the same time, mortgage rates are hovering around 6.1 to 6.2%. Median monthly payments are down nearly 5% year over year, and wages are up about 4%. So affordability is improving at that margin. Now, it's not dramatic, but it is directionally improving, and that matters. We're also seeing something behavioral. More sellers are finally giving up their ultra-low pandemic rates. Buyers are coming back cautiously. They're negotiating aggressively, and they're asking for inspections again. That's healthy market activity. There's a major housing bill moving forward right now. The Housing for the 21st Century Act just passed the committee and is heading to the House floor. This bill tackles affordability from multiple angles, cuts red tape to speed up construction, creates pre-approved building designs, updates FHA loan limits, expands financing for manufactured homes, supports small dollar mortgages, and it reduces regulatory burdens for community banks. The Mortgage Bankers Association supports it, and if this gains traction, it could help supply, which is ultimately what fixes affordability in the long term. Housing shortages don't get solved with rate cuts alone, they get solved with more homes. Now, FHA demand is still rising while conventional may be stalling a little bit. Mortgage rates last week stayed at about 6.21% as a national average. Total mortgage application volume did tick up slightly, up 0.3%. Refinances are up 1%, purchases down 2%. But here's what's important. Borrowers are shopping for product flexibility. We're seeing an increased interest in FHA and alternative loan structures where savings are stronger. That tells me that buyers aren't disappearing, they're adapting. Also, home ownership is growing again. Home ownership rose to 65.7% last quarter at the end of 2025. It's still slightly below the long-term average, but moving in the right direction. Under 35 home ownership increased, ages 55 to 64 increased. The 45 to 54 group, they did see a dip, likely due to move-up hesitation at current rate levels. Meanwhile, rental vacancy rose to 7.2%. Translation? Pressure to buy remains strong. Nearly 60% of renters say they want to purchase within the next couple of years. That demand hasn't gone anywhere. It's waiting for clarity. Now, we did get a stronger than expected BLS jobs report. 130,000 jobs were added, but unemployment dropped to 4.3%. That temporarily pushed bond yields higher and pressured rates. But here's the disconnect. ADP just showed that 22,000 private jobs were gained. Layoff data seems to have been elevated. Other labor indicators shows softness. So there's a growing debate about whether this jobs number holds up, especially given BLS's history of downward revisions. For now, however, the 10-year Treasury tested 4.2%, it pulled back to around 4.17%, and mortgage bonds are battling key technical levels. The trend line we've been watching is still intact, and if inflation cooperates on Friday's CPI report, we could regain some rate momentum. Here's the big picture. Homeowners are financially strong, inventory is rising, buyers have leverage, legislation is pushing towards supply solutions, demand is quietly building. This is not a broken market, it's a transitioning one. If you're a buyer, investor, or realtor trying to position correctly in this environment, timing and strategy matters more than headlines. If you want to run scenarios, review strategy, or talk through what this means for your pipeline, please reach out. Once again, I'm Asher with NEXA Lending, and we're watching this closely every single week. Please make sure you like and subscribe so you stay up to date with the latest updates, and I will see you next week.